Hello everyone, this is Dr. Carlos Carrera Zarco. Welcome to a new session in your module Build Asset Management. In that session, we are going to cover the topic of capital planning and budget and cost-benefit analysis. Here you have the overview for this session. The first objective is that you understand the differences between capital budget and operating budget in asset management. Also, we will describe the process to develop a capital budget in asset management. Also, you will understand the concept of capital returning, and you will understand the process to make decisions regarding what to include in the capital budget. And finally, we will consider how to perform cost-benefit analysis and how to evaluate benefits of activities which are not financially measurable. Well, first of all, I would like to give you an overall definition for capital planning. Capital planning is basically around how to allocate resources in an organization. The common rule is that the allocation of resources must be connected with those areas which have the best value prospects. Normally, we will use financial indicator to check that, such as the return of investment. The return can take place through different forms. It can be through new businesses development, an increased production, greater sales, or reduced cost. But there are also other forms of value which are not connected with financial value. Sometimes the value is in form of meeting different requirements, such as legal requirements, environmental requirements, safety requirements, or regulatory requirements. In other occasions, the value will come in form of sustainment of existing assets or risk reduction. So the important thing here is that you understand that we are going to allocate resources, money to different areas, and we are expecting some value back from this injection of resources. So here you have a definition of budget. Budget can be seen as an allocation of financial resources to a specific function or area, and obviously the creation of budget represents an important commitment for top management. In asset management, we can clearly distinguish two types of budget: the capital budget, known as CAPEX, capital expenditure, and the operating and maintenance budget, known as OPEX, operation expenditure. Capital budget, also known as capital expenditure, is used to purchase fixed assets for the organization. The depreciation of fixed asset is allowed as a current year tax deduction. CapEx is used to acquire new major items for the organization, such as equipment, building changes, new physical assets, etc. On the other hand, the operating budget or operating expenditure is used to operate the business and to purchase expense items and cover outlays required to support their immediate activities. From a tax-wise perspective, the interesting thing is that OPEX can be deduced from incomes in the current year. So this makes that the definition of OPEX is quite connected with the tax system in place for the country in which we are operating. A common fault is for the CAPEX and OPEX budgets to be too widely separated in terms of management function and responsibility. This can lead, for example, to excessive OPEX expenditure in order to maintain old equipment, which should have been replaced earlier from the CAPEX budget. So at that point, it must be clear that the capital asset planning and budgeting involve identification of the most beneficial use of funds for the organization. And obviously, capital planning and budgeting are key aspects in the business development plan. Usually, the business development plan leads into a capital expenditure program that will be consolidated across a number of capability requirement areas. So again, the capability requirements will be a trigger for the business development plan. Here we are going to explore the process for the development of capital requirement plans. The capital requirement plans are carried out for all asset types, and this usually is done annually. Later on, these plans carried out for each type of asset are consolidated into a master development and capital budget plan. From the asset manager's perspective, you need to know that the asset managers need to be fully aware of and involved in the organization's capital budget planning process, because they are the ones in the organization that know better the state of the different assets and that can help in the identification of capability requirements. Here you can see the typical steps that we follow for planning and budgeting for each type of asset. First, the forecast requirements, check the disposal plan to decide which are the acquisition needed in connection with the forecast and disposal plan, to develop the purchase plan, to develop a financial and risk plan for each asset type, and finally forward to aggregation across the different types. Obviously here we can establish a cycle based on the revision after feedback. And here you can see the capital asset budget aggregation across the different types. So we aggregate the financial and risk plans for each type. We check the interdependence of requirements among the different types and we establish our priorities. Later, we perform the capital returning and overall risk analysis. And finally, we are in the position to present the capital budget plan. Obviously, again, this is a process in which we can introduce a revision cycle. It's important that you keep in mind that the bringing together of asset knowledge and business and financial knowledge into a sound decision-making process is an essential part of the asset management contribution to the well-being of the organization. Now we are going to explain the concept of capital rationing. It's pretty common that the demands on the capital budget will exceed the finance available in the organization. So we will need to prioritize the different projects and the decisions as to what items can be included in a given capital budget is known as capital rationing. So in simple words, capital rationing is about to establish the needs and priorities for the projects that we are going to include in our capital budget. We need to consider that some projects are not going to be discretionary because they will respond to some regulatory commitments in terms of safety, environmental issues, etc. Other projects are considered essential to the business, and others are important to keep the ongoing success of the business. In terms of replacement prioritization, we need to ensure that we have sufficient capital allocated in order to meet the requirements for replacement quite in advance. So a good practice is to establish a ranking for replacement need by using a priority order. To provide consistency to this classification, to this ranking, we can define different descriptors for condition and for criticality. Here we are considering two dimensions, criticality and condition, and we will classify here the different assets by measuring criticality and condition, and we will identify which asset needs replacing, which are about average, and we have still ample resources because they are in good condition, so the level of criticality is low. For new projects, usually we check the financial returns. That is measured commonly by using the internal rate of return. Another factor that we can consider for new projects are the risk, but for both situations, for the situation in which we are going to carry out the project, but also for the situation in which we are failing to approve the project. This is known as risk of lost opportunity. So basically we are evaluating what will we gain if we are going to implement the project and what can we lose if we are not going for that project. A critical aspect is to establish a fluent dialogue between asset manager and senior management, particularly about the different merits and risks of the different projects. But keep in mind that it's up to senior management to make the final decision about the acquisition and replacement of physical assets. So, at the end of the day, it's senior management who brings together the various decisions into a consolidated business budget. Also, the direction, monitoring, and control of the capital project portfolio would be an important commitment for senior management. Usually, for the short term, the capital budget is managed for the current year, but also we consider some other medium-term horizons. Here you have a simple example of a capital budget summary. Here you have the name and brief description of the project, the status of each project, and the cost forecast for each project, for both short-term and medium-term. Well, now we are going to explain the cost-benefit analysis. Basically, the cost-benefit analysis is the evaluation of different scenarios where the outcomes involve both financial and non-financial benefits and disbenefits. The principal aim of cost-benefit analysis is to strike a balance between what is financially quantifiable and the more subjective aspects of an issue that we cannot quantify with numbers. So, as I said, not every worthwhile project has purely financial drivers. The following are examples of types of projects where the non-financial benefits or benefits which are hard to quantify in financial terms. The first one is provision for community needs such as health, educational, recreational, or sporting facilities and general user infrastructure. This is a major area where cost-benefit analysis is an issue. The second is meeting regulatory requirements. This is usually in relation to technical, health, safety, or environmental considerations and may include the identification of and compliance with technical regulations or standards. The third one is value preserving or protecting activities, in that they reduce the probability of or effects of deterioration, failure, accidents, faults, delays, etc. Also, we can include in that type the improvements in layout, storage, material handlings, access, communication, or simplifying operations. The exploratory or pre-feasibility studies, which may or may not lead onto business-generating projects. Some examples are geological evaluation of a prospective mineral area, the evaluation of a conditioning monitoring technique for a particular application, etc. And finally, we can include projects connected with research that has the aim of furthering knowledge, but without a specific financial motivation. Connected with the cost-benefit analysis, we have the user-pays principle. As we said before, the cost-benefit analysis is by definition applied to areas where not all the issues are financially tractable. But in any case, we need to recognize that money represents a quite objective measure of good, and the financial approach shouldn't be abandoned too lightly. So any project that can reasonably be costed should be costed, and the user pays principle should be maintained. What is the user pays principle? Basically, this principle considers that the amount paid by the user acts as a regulator of demand and also works against frivolous use or misuse. These payment rules should avoid creating situations where an organization has an open-ended commitment to provide a service at below cost. So the cross-subsidization, it means when assets or services are provided for one group but being paid for by another, should be kept to minimal levels. To summarize, at the end of the day, the idea is that people or entities that are going to use an asset should be the ones who paid for that. We can identify a framework, a process to perform the cost-benefit analysis. And here you have some key steps that you can follow to perform that analysis. The first one is to state the objectives. Second, obtain the basic and key information. Identify the measures that we are going to use to evaluate the different scenarios. To make the selection of scenarios. To perform the financial cost and benefit statement for costable elements. To perform benefit and disbenefit statements for non-costable elements. It means elements that cannot be measured financially. To rank the options and to present the final result as a planning balance sheet. Planning balance sheet is a statement which summarizes the results of cost-benefit analysis, and it typically covers the following points. Identify the services which the project will provide. Identify services that will be lost as a result of the project. It means the disadvantages. Identify the parties who will pay for services and the cost raised for payers, taxpayers, users, and non-users. Identify the parties who will be disadvantaged by loss of amenity. Identify parties which will benefit from that project. For each service and party, specify the benefit in money, physical, or intangible term. And finally, to present the results in the form of a list of gains and losses. So, by following the cost-benefit analysis steps and creating the planning balance sheet, we can perform the cost-benefit analysis accordingly. Also, we can use some figures such as the cost-benefit spider diagram to identify graphically the strength and weakness of the different projects and compare and contrast the different projects against key dimensions. Here you have a simple analysis about the implementation of clinics, one large hospital, of a medium clinic. And here you have the main conclusions for that session. Thank you so much for your attention. I'm looking forward to see you in our synchronous session. Goodbye.